Chris Wood, the equity strategist at CLSA, has started speaking.
Regarding Fed policy, has been no Fed rate hike this year, and I'm expecting more QE next year. Clearly, in the most recent employment data in the US, expectations of a Fed rate hike have picked up. The key reason is that we've finally seen a bit of wage growth acceleration in America. So what I told investors is that if the November employment wage data shows a further pickup, then it's likely Mrs. Yellen does raise rates in December. However, if we don't see if the wage growth number isn't strong, then I would continue to expect no rate hike. So the key issue for me is the average hourly earnings growth data. But regardless of what the Fed does, I think the key fundamental point is that, in my view, the Fed does start raising rates. The yield curve will flatten on the rate hike, will not steepen. Bond market will rally, and that will give a signal that the Fed shouldn't be raising rates, and I'd still expect a reversal of policy and more QE next year in the US. So my view is that the US economy is not as strong as people are saying, and is more likely to weaken in the next 12 months, not accelerate. In terms of India, I'm telling investors that India, while I've still got a big structural overweight in India, the reality is for now that India remains a better relative story than absolute return story. It remains a good relative story because its macro position is much better than most other emerging market countries. It remains, of all the bigger emerging markets, the biggest beneficiaries of lower commodities, lower oil prices. My view on oil is that it's a matter of time before it breaks below $40, so I remain bearish on oil. But in terms of absolute return story, the problem in India is that we still don't see any evidence of a pickup in the investment cycle. And people asked me in the meeting what was my major concern in terms of government policy. My major concern as regards the policy of the Modi government continues to be the lack of urgency displayed in addressing the legacy NPL issues in the Indian banking system. My view is that it's probably conservative to assume that about 15% of loans in India are stressed in one form or another. Most of those stressed loans are in the state-owned banks, and so long as that's the situation, that will delay a pickup in the investment cycle in India, and it means that monetary easing will not be as effective as it would otherwise be. So that, to me, is the biggest concern from an Indian standpoint. From a stock market standpoint, a related concern is that earnings growth continues to be downgraded. The offsetting positive is that we've had significant rate cuts in India, and we will have more rate cuts on the 12-month view. So at the start of this year, I was saying a minimum of 200 basis points of rate cuts in India in 2015, 2016. We've already had 125 basis points of rate cuts, and my guess now is we'll have more than 200 basis points of rate cuts in 2015, 2016. So the rate cuts are the positive. The negative on Indian equities is the fact that we don't see clear evidence yet of a pickup in the investment cycle, and the earnings picture is mixed. But with that, I'll maybe turn it over to questions.
Hi, Sarah from CNBC. I want to talk to you a bit about India. You said you're still very concerned about the banking story, but the government has taken steps, for example, for the power companies, etc. Are you saying that's not good enough? And is that your only main concern when it comes to India? We've also seen a lot of FDI changes taking place last week, which has to be reflected.
No, I would say the last 3 months we've seen a pickup in activity related to the banking system. So that is encouraging, but I would say if you're looking at from when the government took power, there's been a lack of urgency displayed. So we're only now beginning to see a pickup in activity. But this problem was clear when the day the government was elected.
Sure. This is Sunita now from YouTube now. This is basically, are you finding it difficult to convince your investors that India's story is the best story, since that it's relatively a better story? Is it difficult to sell a story like that?
No, but I would definitely say foreign investors' enthusiasm for India has diminished. Obviously, there's been a lot of focus on the failure to get various laws passed. I would say the most important of the laws from a foreign investor standpoint and from my standpoint is GST. But you can't really but it's quite clear that the government wants to get these laws passed, so that's a technical problem related to the fact the government doesn't control the upper house. So you could criticize the government for not managing the parliamentary tactics better, but fundamentally the government's trying to pass the law. So to me, that's less a point. To me, the more important issue is the banking system, because that simply is a constraint on the economy.
Has China's loss been India's gain? Are we seeing capital being allocated to India that was meant for China initially?
No, the people have been overweight India since for a long time, and they're still overweight India, and I'm overweight India. So I think it makes sense still to be overweight India, but that's a relative story. Also, the Indian benchmark weighting is extremely low. So actually, personally, I'd be structurally overweight India even if I wasn't bullish on India, because I think the weighting in the benchmark is too low relative to the size of the economy. So I'm still 3 times overweight India relative to the benchmark. I'm perfectly comfortable with that. But in terms of the stocks I've got in my recommended portfolio, I prefer stocks geared to the urban consumer and falling rates, because I'm expecting more rate cuts in India, and in my view, the urban consumer is in a better situation than the rural consumer. But that's because of what I would say one of the major achievements of the Modi government so far, helped by the RBI, is to bring about a significant decline in inflationary pressures. In my view, the inflationary pressures in India under the previous government were caused by these big subsidy programs, particularly in terms of minimum food support prices and in terms of the make work schemes. The Modi government has cut back on those subsidies, so that's a positive in terms of causing inflation. You've had a one-off decline in inflation, but the negative impact is that it has slowed the rural economy as the artificial stimulus provided to consumption, provided by these subsidies, has been reduced. But that's like a cold turkey program for the rural economy.
Chris, you said, you spoke about banking, and you said you're overweight or you have a good position as far as the consumer-oriented stocks go. The fact is, you've seen the rate cuts, but there's still a lag of 90 basis points in the system.
When you say lag,
they're not passed on all the benefit to the consumers.
Oh yeah, but that's because they're paying for all these NPLs.
Exactly. So I think
well, they're not all NPLs, because obviously officially the NPL level is way smaller than 15%. But it's quite clear the banking system is not healthy, otherwise they'd pass it on.
You also mentioned that the government has cut down on the subsidies, but after seeing the PR disasters and how the government performed, do you think that there could be more focus on giving more subsidies?
Well, no, there could be. Clearly there'll be pressures, but what's impressive so far is that Mr. Modi has not lapsed into that sort of populist agenda. So far he's resisted that.
Do you think you are also bullish and other people are bullish in India because of lack of choice? Where are they supposed to put the capital today in the world?
No, that's partly true, so that's the relative story. But the reality is I don't think the Indian economy is going to get worse. To me, the Indian economy is basically crawling along, it's on a sort of plateau. So to me, it either stays in this range or accelerates. I don't think it gets worse.
By when do you expect the earnings to start showing up in India?
Well, see, the trouble with that question is that relates to the investment cycle, and frankly, I can't give you clear evidence the investment cycle's turning up. There's 1 or 2 charts which look hopeful, but I'd feel much more comfortable the investment cycle would turn up if I saw more aggressive action to address the banking issue. The problem is that the government does not want to reduce the government doesn't want to reduce its stake in the state-owned banks below 50%. The obvious, easiest way to clean out the banks is to privatize them.
But the private sector banks' NPLs are also high.
They're not less high than the state-owned banks. So to me, that's the issue.
But the government is also spending a lot of money. There are announced a lot of big projects that they will be spending money on. Doesn't that help in providing that gets exciting? Do you think the private sector will follow?
Now, the government can help a bit, but ultimately it would be much better if the private sector was driving the investment cycle, not the government. The government program will help. And clearly the government's spending money on big projects like the freight corridor, etc. All that will help on a 5-year view. But in terms of the investment cycle picking up in the next 2 quarters, it's not going to help as much. So the positive points on India, though, remain, the key point remains the demographics of India. So I'm overweight 2 countries in Asia, which are the big structural overweights, which were my same overweights last year, which Philippines and India. Both are very positive demographics.
You mentioned that you expect crude to go below $40, which is good for India. How long do you expect this to stay below the average price?
Well, I'm expecting, to me, it's just a matter of time before oil breaks $40. $40 is the key level because many people globally are assuming that's the bottom. So I think the risk to oil not going below $40 is if Saudi Arabia changes policy. But to me, there's little reason for Saudi to change policy, having only made the change a year ago. The other point about oil is a growing threat of all these alternative energies. More and more people are arguing that solar cost curve is collapsing and solar is becoming more competitive. Then you have this near-term issue of the global warming summit in Paris in December, which may fix carbon targets. Maybe they won't be able to get agreement on those carbon targets, but if they do get agreement on those carbon targets, that will have the practical impact of devaluing fossil fuel assets in the ground.
And how would you play gold if you're not expecting Fed to hike rates?
No, I mean, I retain a position in gold as simply the financial equivalent of a life insurance policy. Because we have had many years of 0 rates. We've had 0 rates since 2008. We've got QE, aggressive QE policies in the Eurozone and in Japan. If we get a resumption of QE in America next year, the risk is that markets finally start to question the credibility and, do these central bankers know what they're doing? If you get a situation where markets test the credibility of central bankers or question the credibility, then the only practical way of ensuring that risk is gold.
Hi, Chris. This is Abhishek from Reuters. I was wondering, in China, that weakness and stock out has been a big risk for markets, including India. What do you make out of these signboards that have started coming in China, offering 14% return, shadow banking, gain on fraud? Would it become a risk for equities again going forward?
Sorry, which products?
The wealth management products.
Well, we had a boom in wealth management products in China since 2008.
What's that?
We've had a boom in wealth management products in recent years in China. That's not new.
Yeah, but now they've started the IPOs again in China. So
no, they resumed the IPOs in the stock market from last week. But what's been going on in the last 2 months in China has been a bond financing boom. So they eased when they had the IPO freeze in the stock market. They eased conditions for issuance of bonds. And you've had a bond bull market, and you've had corporate bond yields collapsing, government bond yields collapsing, and the bond yields converging on the government bond yield. So that's eased financing conditions for corporates, but it looks a bit speculative, I agree.
And one more thing, I understand your view that there might be more QE in America in the coming year. They might have to reverse the much talked about this in the hike. But historically, defensives and other sectors, they've not performed well whenever US yields go higher. What sectors in Asia, including in India, you think would do good if say US is on path of raising rates?
No, the US really, if I'm wrong and the US succeeds in normalizing monetary policy and rates go up, 200 basis points next year, then the sector that will do best is things like US banks.
Not energy, materials, which are available at low valuation.
And they might do, but if you really think the US is going to succeed in normalizing monetary policy, the best equities you could own are US bank stocks, not emerging markets. In that environment, emerging markets will get hit by the stronger dollar.
What's your view on commodities, especially metals?
No, I think no, I'm not positive on commodities. I'm just less, but I'm more bearish on I'm more bearish on oil than the other commodities. Why? Because the other commodities have been going down since 2011, whereas oil's only been going down for the last year.
Sir, this is Gaurang Sinha from Wood TV India. So my question to you is, the Indian government particularly is trying to talk about more equity infusion in a lot of the big projects that have been stalled particularly. They try to set up the National Investment Infra Fund as well. How optimistic are you that the government will be able to attract equity into Indian projects, particularly stalled projects, which have been stuck perhaps with the lack of finance?
You mean from international sources?
That's right.
No, look, I think if they can set up terms where the returns are credible to foreign investors, i.e. foreign investors believe they can get foreign investors can get double-digit returns in rupee or Indian infrastructure projects which the central government has convinced them the returns are real, then I think that's entirely feasible.
Also, so, the government has also been trying to, there's in terms of external commercial borrowings, as well as the overall foreign investment environment, the government's been trying to make a lot of moves as far as liberalizing a lot of policies, particularly with foreign direct investment and portfolio investment as well. Perhaps with the short-term reforms as well, how much of a positive impact do you see this as? Is this what the government perhaps needs to attract greater investment?
All right. I think the broad contours have been laid out by Chris Wood. India is maybe a relative return story, but not quite an absolute return story. Not speaking levels yet, but clearly a little more bullish on the urban economy and urban discretionary stocks, because he sees 200 basis points of rate cuts. We are at 675. He's actually expecting 475. That's the kind of rates we had in 2003, around just before the 9/11 period. We haven't seen those kinds of rates, of course. We saw rates go down during the Lehman crisis, but not by as much. So that's a very big call that's coming from Chris Wood. Not positive at all, but singling out the urban discretionary stocks because of the expectation of rate cuts from the Reserve Bank. Positive in India on a relative basis.